Matt is known to all of us at NIBA as not only a very excellent attorney, but he, in behalf of Baker McKenzie, volunteer services to the NIBA, to our board, and to our board members. So we're very grateful to him and to the fact that he could be here today. Matt is a partner at Baker McKenzie. He's based here in their Chicago office. He serves as the global head of derivatives, in which he works with 20 derivatives professionals around the world. He also serves as the head of the firm's North American cryptocurrency practice. This is Matt. Thank you.
Thanks, Melinda. Appreciate it. Hello, everyone. So I'm really pleased to have a fantastic panel with us today to spend the next hour or so talking about something we all, I'm sure, read about, but maybe not all of us know too much about, and that's cryptocurrencies. And so let me introduce our three panelists. We have to my far right here, Chris Tanger. Chris is an entrepreneur in the fintech space. He's a consultant. He's a system solutions architect and a very, at times, active trader of Bitcoins and other cryptocurrencies around the world. So he's going to share some insights in that respect. To Chris's left, we have Brian Kelly. Brian's the founder and CEO of a fund manager called BKCM. And BKCM advises one of the first hedge funds devoted to cryptocurrencies, the Digital Asset Fund. And Chris is going to share some thoughts with respect to launching a fund and some market structure implications regarding cryptocurrencies. And then to my immediate right is Sam Kramer, a fellow partner of mine at Baker McKenzie. Sam is involved on a daily basis with international commercial transactions, domestic transactions, lots of technology, and has a very highly regarded niche when it comes to blockchain. And along with me is involved in Baker McKenzie's North American efforts to address fintech, cryptocurrency, and related issues. So that's our panel today. Before I hand it off, and we've all heard, right, a little bit about Bitcoins, a little bit about cryptocurrencies. If you've been reading the papers lately, meaning in the last 24 hours, you may have seen some headlines that Jamie Dimon of JP Morgan Chase has characterized Bitcoins as a fraud. Nothing short. Significant words. And according to Jamie Dimon, he expects this market to collapse sometime in the near future. Interestingly enough, after he made that assertion, if you will, John McAfee, we might all know from the security firm by the same name, quickly came out and said, well, you know, that's rotten nonsense. It's here to stay, gave some economic reasons and so forth. And it seems like we've got this sort of war of words now between really titans in the financial industry, software industries. I should note that Warren Buffett, do we all recall what Warren Buffett said about derivatives a decade ago? That they were weapons of mass destruction. Very good, right? Well, he also said that Bitcoin is essentially a weapon of mass destruction, and that market is going to collapse as well. So we've kind of got this, you know, back and forth tide in the press now, the headlines, the titans getting involved, this war of words, if you will, which is really interesting, no doubt affects the price of cryptocurrencies. We've seen Bitcoin retrace a bit over the last 5 days from a high of, 5,000 or so, maybe 3,800 or so. And then meanwhile, we've got, you know, some sort of market structure issues going on. We've got China, which recently banned ICOs, initial coin offerings, which has sort of become the new way to raise funds outside of securities, but via tokens, via some, you know, a cryptocurrency that people essentially make up and name and market. In the US, we have the SEC. Some of you may have heard or seen that the so-called ICOs, which has been probably the most robust vehicle in promotion of cryptocurrency, said that, well, if you do an ICO in the US, it's likely going to be characterized as a security, in which case you have to deal with all of the federal securities laws. The regulator most of us know, dear to our heart, the CFTC, and some of you may have heard me speak about this before, but has been intimately involved with respect to cryptocurrency regulation. 2.5 years ago, it deemed, called it virtual currencies, but cryptocurrencies as commodities. And by virtue of deeming it a commodity, that became the hook for it to bring enforcement actions against Bitfinex and others. And so we've got market structure developments like that. We've got product developments, which we'll get into a little bit. Things like forking. Bitcoin recently forked. What the heck does that mean? Sam Kramer is going to explain that to us and a whole lot more. And issues regarding interoperability. And I thought as well, let me ask real quickly, just a quick show of hands, how many of you feel like you know a fair amount about cryptocurrencies, just generally baseline? Okay, so we've got a handful or two. You know, I think it'd be great, maybe Sam could start off with this, but talk a little bit about Bitcoin with the capital B and Bitcoin with a lowercase b. So there kind of is a difference, right? We talk about Bitcoin with a lowercase b, we're talking about the cryptocurrency itself, that which you trade, the actual token. We talk about capital Bitcoin, we're talking about the technology that underlies Bitcoin. Those are two, they're related, but they're fundamentally two different things. And so think of blockchain, the technology, again, that underlies various cryptocurrencies. It varies from one cryptocurrency to the next, but those are two different things. And so when we hear somebody like Jamie Dimon or Warren Buffett or whomever else say, well, Bitcoin's, you know, it's a fraud, that market can't, you know, sustain itself. What they're really talking about, I think, I'm going to say, is the actual cryptocurrency, not the technology that underlies it. And the technology that underlies it seems like that's here to stay. And it has backers in JP Morgan Chase, it has backers, you know, with Fidelity, with all the major financial institutions. So there's a difference, and one of our panelists or a couple can get into that a little bit. So let me turn it over to Sam Kramer. Sam is going to give you sort of a foundational overview of what is Bitcoin, what is the technology, what is blockchain, all of the important information for which maybe you didn't want to ask a question somebody because you thought it was a silly question, but Sam is going to cover the landscape, and then we'll turn it over to Brian to talk about some hedge fund and market structure implications. One quick thing, if anybody has a question, from my perspective and our, all of our perspective, you don't have to wait till the end of the session. Let's hear it now. Feel free to jump in, and happy to have a conversation. Sam?
Great, thanks so much, Matt. I appreciate it. If any of you get confused as to who the lawyers are, ties on this side, we're the lawyers. These guys are the ones who do the real stuff here. So, yeah. So thanks for the introduction, Matt, and some very interesting comments you made in a lot of aspects about cryptocurrencies and Bitcoins. And just one comment on the ICOs after the SEC report and investor alert that they sent out. There have been 2 ICOs in the US that have claimed to be SEC compliant. One of them, Filecoin, is being offered only to accredited investors to avoid registration requirements. The other one, Block Mason, really quite interesting. They're doing an initial coin offering with a digital token that actually has a use besides the speculation on the investment itself. It is the token that operates their platform for offering credit. And as a result, their claim is that it's going to fall out of the regulatory requirements based on a little bit of guidance that was in that investor report. So just to comment on that, the news breaks all the time. Any of the things that we say here may not be true tomorrow because it really is an area.
Or this afternoon.
Or this afternoon, right. There's some
called Bitcoin time. It's
right. Some real volatility in this area, which makes it exciting, I think. Anyway, for a technology lawyer, which is basically what I do, Bitcoin and blockchains generally are really interesting in their potential disruptive capacity. Why do you have a cryptocurrency to begin with? Why create one? And I think that many people talked about it kind of coming out of the Great Recession, when there was a pretty fundamental loss of trust with centralized authorities. And the idea was, could we create something of value and a medium of exchange that had 3 qualities to it? It has to be secure, decentralized, and have no trusted third parties required to make the system run. And in 2009, when the Bitcoin white paper was released, it described a system that did all of those things. Bitcoin, capital B, the system, the technology that creates these tokens, is secure by using cryptographic functions to hash and secure the transactions and transaction data. It's decentralized in that it operates on a peer-to-peer network rather than having to go through any centralized computing network. And there are no trusted third parties, and that transactions are validated on the Bitcoin blockchain using a concept called distributed consensus. And we'll talk about each one of those to understand a little bit better about how it operates. Had I known we had the screens here, I would have brought my 40-page slide deck with all the pretty pictures and things. I'm looking at a couple of slides just to remind me of some things, but if I skip over something doesn't make sense, please raise your hand. So,
And I'm sorry, we can make that available, can't we?
oh, absolutely.
Slides,
Yeah, and then I
slides.
can make an even larger slide deck, yeah, if you really want it.
Therefore you ask for it.
Yeah, exactly. Happy to make it available. In talking about Bitcoin and how Bitcoin operates, there are really two aspects of it that are important to remember. There is a minting capacity. Bitcoins get created in a particular way, which I'll talk about, which is an activity called mining. But before we get to the mining part of it, Bitcoins can also be transacted. They can be purchased on exchanges for fiat currency. They can be exchanged for other virtual currencies, and they can be transacted between parties, including for the purchase of goods and services. There are businesses that accept Bitcoins and other cryptocurrencies. So let's just talk a moment about a transaction. What happens when you transact in Bitcoin? Well, you need to download a software program called a wallet, which basically will enable you to acquire Bitcoins, to buy them, mine them if you can, which I'll talk about in a little bit, and to transfer them. And the real important part of this is that Bitcoins, when we're talking about the movement of Bitcoins, you have to stop thinking about the tokens themselves. Really, what's being transacted are records of prior transactions. So the issue is when I transfer Bitcoins that I have in my wallet to Brian, what I'm doing is I'm transferring records of prior Bitcoins that I have received. And it's that record that moves back and forth on something called a blockchain. And a blockchain is really a group of these transactions that are structured and have a data structure that works in a particular way. And the valuable thing about it is that it's a distributed append-only ledger. And the two features of that are kind of critical to making the whole system work is that it's a distributed ledger. It doesn't exist only in one place, this record of transfers of buying and selling Bitcoins. Everybody who's playing in the network has an identical copy of this record. And you might think to yourself, oh, okay, yeah, that's going to make hacking very difficult because I would have to hack everybody's copy of this ledger. And when you have dozens, hundreds, thousands, or millions of people who all have a copy of this ledger in a peer-to-peer network, it becomes very difficult to change everybody's copy of the ledger. The other aspect of this, besides the fact that it is, decentralized in this manner, the transfer of records is also secured by a cryptographic hash, by the double SHA-256 hashing function, which so far has proved to be impenetrable. And so what we do is we get these strings of numbers, these hashes of the transactions. What's the value of that? Well, even though there may be a lot of activity that goes behind it, once we get this number, you can't associate that number. You can't, I guess best way to put it is you can't reverse engineer anything about the transaction from the number you receive. And the numbers either match or they don't match. And we'll get to kind of what that means. But if I were to transfer Bitcoins to Brian, I would use digital signatures. I would use my private key to initiate a transaction. And we would know your public key that I would send Bitcoins to you, and again, that's the record of that particular transaction.
Can you just explain
Yep.
what a private key is, what a public key is?
Sure. So this is using the same digital signatures, kind of the same technology that you might see behind something like DocuSign or some of these electronic signature systems, where what you do is you have, I think I need to move this up a little bit, there we go, where you have a private key, which you need to keep secret because it's how you sign and authenticate your own transactions.
So like a password, my own ID?
Yeah, although it's quite a bit stronger than
Yes,
that.
right.
It uses an elliptical curve hash function that really is quite strong. And then there's a public key, which is like a public address, like think of it like a mailbox almost. And so if I want to receive things from the world, I tell everyone, oh, here's my public key, here's my address that you can send it to, but my private key, I need to keep private. So if there are issues in terms of loss of your cryptocurrency, one of the first places to look is, did someone steal your private key and kind of act like you? So in a transaction, when you are transacting and transferring a Bitcoin, the private key sender sends that Bitcoin transaction to the public key recipient. And it's all of these transactions are hashed. They go through a mathematical function where you have a number and the number appears to be arbitrary. It's 256 bits and you can't figure out from that number how big the transaction was, where it came from, what the message contains. It really is just an arbitrary string of numbers. So in doing that, fine, we've got a transaction, and it would be relatively easy for Brian to determine, okay, if you're transferring this to me, do you have a balance in your wallet? If I need to transfer 10 Bitcoins to you, do I have 10 Bitcoins in my wallet? That's a pretty easy thing to be able to verify. The issue that Bitcoin was really structured to deal with is the double spend problem. What happens if I only have 10 Bitcoins in my wallet and I send the 10 to Brian and Chris at roughly the same time? What happens then? What structures can we use in order to validate? Well, how does the protocol itself work? That'll help us figure out how this double spend problem is resolved. So what happens is my transaction to Brian, my transaction to Chris, to others, there are lots and lots of these Bitcoin transactions that are kind of floating around, and they get gathered up by people who are called miners. Who's a miner? Anyone on the network can be a miner. What they do is they listen for transactions on the network, and they say, oh, there's a transaction here, I'm going to gather them up and put them into something called a block. And a block is just a group of transactions. Now it's structured in a particular way, again, using these hash functions and something neat called a Merkle tree that we won't have to go into, that's kind of hashes of hashes to get kind of one number built up. But essentially they're creating blocks. And all of the miners who are putting these blocks together in order to validate transactions, they're racing one another. So we've got this blockchain, and we want to say, okay, who's going to propose the next block of transactions on the blockchain to show that they've been validated? So if I'm a miner, I'm racing against other miners to put together blocks of transactions in order to do something that seems a little odd, and it's called proof of work. And that's the distributed consensus system on which the Bitcoin blockchain works. What does that mean? It means solving an arbitrary math puzzle that I'm trying to create these answers. And I keep trying over and over again until the answer that I come up with meets certain parameters that are required for the block. And it usually has to do with how many zeros does it start with. But it's very much an arbitrary math puzzle. There's no rhyme or reason to it. It doesn't provide any useful function within society. right? Other than showing that a whole bunch of work went into answering this arbitrary math puzzle. So parties keep doing that, and the interesting thing about the technology behind the Bitcoin blockchain is there's no strategy that makes someone who's really good at math or who really understands this stuff more likely to be able to solve this particular math puzzle. It's called puzzle friendly, in that really you're talking about trial and error, hashing over and over and over again until you come up with this number that starts with enough zeros so that it fits the requirement of that particular block. What does that mean? It means that the more of the computer resources of the network, the blockchain, the Bitcoin blockchain network that you command, the more likely it is that you're going to solve the next block. But why would you want to do that? Why would you want to engage in the time and effort to do this math puzzle over and over and over again, and to take computing resources and electricity and all these kinds of things to do it? Well, that's where the money supply comes in. And that's what we mean by mining a block. Because when you solve this puzzle, you get something called a block reward, which at the moment I think is 12.5 Bitcoins that get released if you solve this puzzle. And as Matt said, if we're anywhere between $3,800 to $5,000 a Bitcoin, and you get 12.5 for solving a block, that's pretty good for what essentially is 10 minutes effort, because the software behind the Bitcoin blockchain is parameterized in such a way that a block gets solved on average every 10 minutes. So every 10 minutes, a block is getting solved, and if you were racing to solve that block and someone solved it ahead of you, well, too bad. You got to start over, gather up a bunch of transactions, put them in a block, and then try and do this math puzzle again, et cetera, et cetera. And you may have heard of mining pools and all of these things where people are getting together and purpose-built computers that are only focused on solving Bitcoin math problems. And they're doing this because there's money to be made in terms of getting this block reward. There are also little transaction fees that are included in it as well, but really the brass ring that people are going for is to get this block reward.
I was going to say there's actually now a publicly traded company whose shares you can buy that is devoted exclusively to mining. So it's sort of, I think,
Yeah.
the one and only.
MGTI, it's
Yeah.
John McAfee
Yeah.
is part of it. And they're buying mining rigs and doing this. And you know what Sam just described is exactly why Jamie Dimon's wrong that Bitcoin is a fraud, because Bitcoin doesn't exist without that economic incentive. The blockchain doesn't exist. If you take away that economic incentive, that coin, you have a really fancy, really not very usable database. You'd just be better off doing it the old way like JP Morgan does. This system is designed to do what JP Morgan does, but better, faster, and cheaper.
A question?
So on that note, what happens when we hit the 21 million?
Right.
Where do we go?
That's a great point. So once we hit, and what that means, the 21 million is the idea that we know when the system was started, because of how the math works, and what happens is this block reward cuts in half every 4 years. So it started out at 50 back in 2009. Every 4 years it's been cut in half. We're at 12.5. And at a certain point, we will hit the end of the block rewards. We will have mined all of the Bitcoins to be mined, which is 21 million Bitcoins will be in circulation. There will be no more than that. What happens at that point is there's something I was mentioning before called the transaction fee. Right now, transaction fees are essentially voluntary. Think of them as like a tip that you may put in when I initiate the transaction and I send my transaction to Brian. I can either rely on the fact that my transaction is going to get scooped up with everybody else's so that a miner is going to get this block reward when they mine a block that has my transaction in it, and that's why they want to grab my transaction. But I can also add this tip, this transaction fee in there to make it more likely that you'll grab my transaction and not Chris's. My transaction fee, again, it being voluntary, might be larger than yours is. And therefore, the listening nodes on the network will say, "Ooh, let's grab that transaction. I'm going to get a few more pennies out of that one by including it in there." That's my long-winded wind-up to answering your question, which is, once we hit the end of the block reward, what's going to happen is the transaction fee will move to becoming a requirement. The only way people will include your transaction is if you put something in that's really meaningful. And when we get to a moment about the Bitcoin fork with Bitcash, what's interesting about that is one of the major movers was to increase the maximum size of a block. You increase the maximum size of a block, you get more transactions. You get more transactions, you get more transaction fees per block. And so I think that's where the incentive engineering is going to move to.
Or you get less transaction fees because of scarcity, though, in the block.
You could,
But that ultimately kills the network, sort of, or limits the network to it being digital gold, but not digital silver. Whereas if the block is really big, it can be digital money, period. If the block is really small, now it's like an interbank transfer type thing. There's a limited number of nodes.
right, exactly. And there are many, many uses, right?
So maybe let's shift gears a little bit here, and let's go to Brian. So Brian, again, manages money with respect to cryptocurrency trades, investments, and so forth. As I mentioned, started a hedge fund. Brian, why don't you just lead off a little bit? What was it like? What kind of challenges in starting a hedge fund?
Yeah.
All in the rearview mirror.
Right. Well, not all in the rearview mirror. We still deal with it every day. So in general, the digital asset fund that we manage is like any other hedge fund out there. Master feeder structure. We had to pay a bunch of guys in ties a lot of money so that they could write up all these documents. And so there's nothing different there. Where it comes down to the difference, first of all, there's a bit of a learning curve, as you're all kind of learning here, quite a bit of a learning curve to get into this space and really understand the nuts and bolts of it. That took me probably about 4 years of trial and error to try to figure it all out, and I learn every single day. Secondarily, the bigger issues with this, number one, you have to talk about custody. There's no infrastructure in this space. There's not a prime broker that you're going to be able to go to. You have to self-custody the assets. You have to get into things like cold storage. You have to get into things like multi-sig and making sure that the private keys that Sam talked about, those private keys, if anybody gets them, then they have all the money. So, presumably you got to have a pretty good storage system, which most hedge funds don't. So, one of our most important employees at our firm is our chief technology officer, because he's in charge of making sure our private keys don't get stolen.
He's the treasurer, too, in a way.
In a way, right, absolutely. So that's a big thing, and that's actually a big hurdle for a lot of institutions to get into the space. Once we solve that issue, which people are working on now, I think it'll be easier. The second thing that is challenging or different in this space are the exchanges. Most of the exchanges, and all we were talking earlier, what's an exchange? It's a website with a trade matching engine behind it. And anybody in the world can spin one up. But now, once I send my Bitcoin to that exchange, effectively that exchange has control over my Bitcoin. So I better make sure that I'm going to get it back. Now, they can be hacked. We've seen that. They can be fraudulent, and they can take it. So, as a hedge fund, a consideration for us, we have to make rules where we say, we don't hold any money, any Bitcoin or any other coin, at an exchange for more than 24 hours. In reality, it's usually a couple hours. We do the trade, we pull it off. So we are kind of doing all the back office stuff that you might outsource in another hedge fund. We have to do that all until the infrastructure builds out. And then I think the other thing, obviously, is the volatility. And we don't really have any hedging vehicles yet. I think the CBOE is saying futures and options in Q4. I think that's the last I heard. Futures and options on Bitcoin. But if I want to hedge, I have to go to cash. I have to go to US dollars. And it's not terribly hard to do, but it'd be much more efficient if we had a futures and options market to do it. So, I mean, that's kind of the general, this is what it's like to set up. Yeah, go ahead.
If you're going through the exchanges that are unregulated and have the security issues, aren't there futures and options exchanges set up the exact same way? why are those not an option for you?
There are a couple. So there's BitMEX, which is they do swaps. That's the closest thing we have to a futures exchange. It is an option. It's not an option for U.S. investors. That's another part of the equation here is that because the U.S. regulations are unclear at best, a lot of companies just say, hey, if you're in the U.S., we don't want to deal with you. Secondary to that, every state has their own regulation. So if I'm sitting in New York, but I want to do a trade with somebody at an exchange that's in Montana, I might not be able to do it because the exchange says, you know what, New York has really bad regulations. Anybody who comes in from New York can't trade with us. So that's another consideration out there. In terms of the swaps and BitMEX, we don't use any leverage, so it's not an option for us. We're US-based investors, so that's not an option for us. The difference, if we had a CBOE product, is now you have the CBOE clearing mechanism behind it, and I'm not sending my private key, right? Presumably I have a prime broker, and we have that entire mechanism set up. So I think once we get that, you're going to see a lot of interest in trading futures and options because there's a big appetite for it. Yeah.
Plus, we need more markets. I'm sorry.
Okay, if I trade common stock, I know that it's regulated, there's anti-insider trading laws and whatnot.
Yep.
How about if you trade the cryptocurrencies? How do you know that there's no other participants with insider knowledge that?
Yeah, so
There totally are.
yes.
And that's the way it is. It's the rough and tumble of the truly free market. You're out there, and there's market manipulation going on, and in a way, technicals. I mean, there's a reason why there's technical trading. Somebody knows something you don't. There's a reason why technical trading works, kind of, some of the time. I think in the cryptos, probably technical trading works better because there's a lot of insider information. You see some little blip in the market, it means something. It means someone knows something. Tons of that's going on. Tons of market manipulation. That creates volatility, which can create profits if you're trading it actively. So that's the good part. The bad part is, who knows when there's going to be a market move and why.
But just to be clear, the insider trading rules do apply to this market. So
They do.
if anybody's thinking, hey, this is a great market, let me go and get some inside information, you're probably going to have to call these guys.
But they won't protect you now. So, maybe those people will end up in jail someday.
It's
but-
still illegal. So I mean,
Yes. So don't try to do it.
yeah.
Okay, Brian, you talked about an exchange. We just heard Ledger X got approved. There's
Yep.
another exchange on the way called Because. Ledger X is a SEF, and there's going to be no intermediation.
Yep.
Because is setting up as a potential as a regular futures exchange. You mentioned SIBO has something in the works.
Yeah.
What are you looking for? Would be most ideal to grow this market and to get people to trade?
I think something like CME or SIBO coming out with a product that is that matches everything else that every other hedge fund does. Because the biggest problem right now, if you're at global macro funds are into this, and that's my background, and so you have currency trading, it's a very natural step. If you're at a global macro fund and a major one, you have to amend your LP documents to be able to trade these things. But if you have a futures contract that's a SIBO or the CME, then you simply just flip it on. You just have your prime broker flip it on. So that type of common type of contract that we're all used to and already fits into the systems that every hedge fund and every mutual fund have, that's what we need.
One thing to watch out with regulated futures and options on Bitcoin as they come is there isn't regulated regular old underlying trading. And the SIBO's contract is going to be based on the Winklevoss twins bit index, which is based on a plethora of exchanges. You still have the underlying Bitcoin price heavily subject to market manipulation, insider trading, those sorts of things. So now you're trading something that's levered up on top of that. Just be aware of that. That's going on.
Yeah, and just to add to that, so that's the model, that's the index that the SEC rejected in not approving an ETF based on.
And probably with good reason. I'm skeptical
Probably.
about the index underlying there because I look at that and I go, well,
Yeah. So there's no sure thing the CFTC is going to be comfortable with that as well. So obviously time will tell.
and it probably is the best solution. It's probably the best way to go. There is no good index. The only index that may be better is if you put together your own and you go, okay, I'm going to take these 30 Bitcoin exchanges. I'm excluding that one this week because it's looking dicey. You know, there are rumors flying around about this one. Its price, there's an ARB there. It's off by $100. Why is that off by $100 for a week? That's what happened with Mt. Gox when they went under. It was off by a factor of 300%. I actually bought some Mt. Gox coins as a distressed debt play, and I may still win because eventually I might get it back. It's still in bankruptcy court in Japan, but we'll see.
So, Chris, just to pick up on this, I mean, I'm almost getting the sense, and for somebody who's been in the trenches actually trading these products, it sounds like it's a little bit, you know, what we think of as the Wild West.
It is the Wild West still. It was more the Wild West a few years ago, but it's still the Wild West. I think there's a lot of profits to be made in the Wild West sort of trading. You know, trading outside of the U.S., trading off of Coinbase is regulated. It's here. It's like PayPal. It's easy. You can install it on your phone. You can sit there and buy and sell. That's not the Wild West so much, but still, the market's going to get moved. It's going to get moved by China. It's going to get moved by, you know, who knows where. I noticed for a while there were correlations with the price of oil. And I'm like, wait a minute. The amount of BTUs, the amount of energy in oil, is not even close to coal. Why would oil affect Bitcoin prices? And I thought about it, and I'm like, well, in the oil industry, people flare off oil all the time when oil prices are low. And when oil prices were low, maybe that flare-off was being used somewhere to run a generating station that was powering Bitcoin miners and then depress the price of Bitcoin. So that was my best theory. I don't know if it's a good one, but because the BTUs are like 30 times different than coal. Coal's way cheaper. So.
I have a question over here, actually.
Yeah, Chris, further to that, can you talk about the scope? Because, you know, daily, you know, you can trade this market 7 days a week, 24 hours a day, and you see some crazy stuff overnight because why? Like, just give us some.
Well, so it's global, I guess, and different countries have different things. The most crazy stuff, what's lost me the most money, is government action rather than inaction, which is, you know, China, the regulator opened their big yap and had to be like, this is slightly more illegal than we previously said, and the price crashed. Anyway, that was the $1,200 peak. And they've continued to do that, and that's happened like 4 times, and the ICOs were rendered illegal and whatnot. Anyway, prices can change for all sorts of reasons, rumors. There are also a zillion Carl icons out there in Bitcoin and in other cryptocurrencies. So you go along, some coin's been trading at 0.01 cents a coin. Namecoin was an example. It was the first altcoin. And Namecoin was trading along for years. I bought up a bunch of the stuff because I'm like, this thing's valuable. Namecoin basically takes care of internet domain naming system in a decentralized way where no government's controlling it. That's how governments censor websites like offshore gambling sites and whatnot, is they poison the DNS. So you can't get to it anymore. But Namecoin takes care of that problem. Nothing happened. Finally, the developers that originated the thing started working on it again. And then they started posting about it. Price skyrockets immediately. So that's a Carl Icahn type move. Buy up a whole bunch of coins, go and hire 1,000 developers to work on it, and you could make billions of dollars. Probably shouldn't be telling you this, but anyway.
Can you address the impact of market fragmentation? So if I'm in hypothetically, you know, there's a market in Hong Kong, Bitfinex, right? There's a maybe Bitflyer in Tokyo, whatever. Are those prices correlated, synchronized? Are they arbitraged out, price differences?
So,
talk a little bit.
In the early days, I was making a lot of money off of ARB. And I think, honestly, I think there was dark money maybe coming into the system, possibly. People wanted to get money off the books. There were no records in the early days. There was no regulators were basically saying, oh, the Fed was like, oh, that's nothing. It's never going to amount to anything. We don't need to worry about this, that sort of thing. This was back in like 2012 or whatever. Well, Bitfloor was a U.S. exchange. It was based in New York. Basically a website. They took cash in. You could deposit cash pretty much anonymously. And so what happened is the price on Bitfloor was 10, 20% higher than the price in the rest of the world. Well, I started wiring money to other places in the world and selling it on Bitfloor. Now, I suspect what was happening is just massive inflow of money because this money had an opportunity to go somewhere without any record. And so that money is gone now. It's disappeared completely. It's really the IO that's regulated and the paperwork there where the money comes and goes. And I don't know if that's what was going on, But I did that, and I made a lot of ARB money on that, trying to bring those market prices closer to each other. And so that's one reason that can happen.
The other reason is different capital restrictions. So you'll see right now, China, quite a bit of a capital restriction, but India too. South Korea. There was about a 30% ARB there, and it's very difficult. Once you can buy Bitcoin here and sell it for 30% higher in South Korea, but then you can't get the money back. So that creates a lot of ARB. So the markets are fragmented.
Right. But for 30%, you can get the money back apparently.
Well,
it seems to me that part of the value of Bitcoin is that, unlike regular currencies, governments can't just print it, you have to mine it. But isn't that fundamentally the biggest flaw in the whole thing, in that governments have a powerful incentive for this not to work? And as we've seen of late, the whole thing's finished when a government just says, this is now illegal. Anybody with Bitcoin faces a $100,000 fine next week.
There may be a way, and Matt, maybe you can weigh in on this. There may be a way.
My point is, what's to stop a government creating a cryptocurrency?
Well, they could,
Isn't
and
that gonna happen next?
they could mandate that you use it, right? But there may be a way to protect cryptocurrencies, and I would like to see it carried out. In fact, protect money in general, which is that in a Bitcoin transaction or cryptocurrency transaction, what happens is you digitally sign. It's just a big bunch of ledgers, and they're all in one ledger, the blockchain, right? And in there, you start out with, forget how we start, but you've got money. I've got 10 in mine, you've got 12 in yours. All I do is digitally sign something saying, my wallet ID, 123456, some random number, gives this wallet ID, 23457, some other random number, 5 Bitcoins. And you take that check that you just wrote and you signed it in a way that's an unforgeable signature, and you transmit it to the network, and all the nodes hear it, and they incorporate it in the blockchain, and it's signed and sealed. It can't be reversed anymore. When you do that, that's a document, that check is. And that would be like, a document is text, and you could even probably encrypt it using words. Well, that's speech, right? Isn't speech protected? You can't deny someone the right to sign a document. So I think this could go to the Supreme Court someday, and it could say it's unconstitutional to restrict the flow of money, because even banknotes are notes.
Interesting thought, although I think that would be commercial speech, which is subject.
Okay, so maybe that's why I wanted you to weigh in on that.
But to answer your question, yes, can governments ban this and say it is illegal to use Bitcoin? They absolutely can. They just did it in China, and you saw the price come down. That being said, there's more to this than just a global currency. This is being used as a new way to venture capital. You can have stock certificates on this. So, I'm not of the opinion that Bitcoin will be the end all and be all. I'm reminded that Yahoo and Netscape existed well before Google was even thought up of, right? So we are going through these growing pains. I don't think all the governments in the world will ban it. In fact, Japan called Bitcoin not legal tender. They made it an official form of payment. South Korea did the same thing. And the SEC has been relatively lenient. Now, if Bitcoin gets to a point where it's so big and it is that global currency and it's a threat to central banks, sure, that's an absolute threat that can happen. But to the extent that it's a peer-to-peer network. So if people still want to trade it and still want to interact with Bitcoin, that's going to be very hard to ban that. But to your point, can they ban exchanges? Sure.
Yeah, and here in the U.S., while we have the SEC, sort of in the outer bands, along with the CFTC and other federal regulators, the Federal Reserve has basically said, hands off. We're gonna let this evolve for the time being. It could always change its mind, but as more traction, then it becomes it's difficult to cut across that grain. So, and also a number of states have actually sanctioned it, legalized it, and said that Bitcoin, other types of cryptocurrency transactions, including the state we're seated in here. Illinois has been very, very pro cryptocurrency. So if you're engaged in money transmission solely with respect to cryptocurrencies, you don't even have to register in this state. Not all states are like that, but a couple of handfuls are. I think there's a question. Yeah.
Yes. You mentioned that you've used Coinbase, and I was just wondering what exactly, I mean, you talked about Coinbase, but what exactly you do in your own trading in terms of what platforms you use, exchanges you use, and how do you navigate?
So I don't trade a whole lot at the moment. Years ago, I traded more. I used mostly Bitstamp. I've traded on Mt. Gox, BTCE. Bitcoin 24 was one that was shut down by the regulators. BTCE obviously was recently. I did have some name coins on there. And frankly, I think that they overstepped their bounds by taking away access to my money. They have collateral damage. Would you come in and would you raid a building like this just because there's a bank in there that did something wrong and take all the stuff in your office too? I don't really like that. That said, I didn't have very much there because it was, a little more of a risky venue than some of the others. Bitstamp's one of my favorites. They made it through, or one of the oldest and biggest. I think they've done a really good job at being entrepreneurial and running this thing. Brave new frontier, but they've also dotted their I's and crossed their T's where they needed to. I traded on a place called ICBit, which is there was a question earlier about futures and options exchanges. It was a Bitcoin futures exchange where Bitcoin futures contracts were denominated in Bitcoin and cleared in Bitcoin. And basically what they did is all the counterparties shared the risk. If someone didn't have enough margin and the market actually swung too far, then what would happen is everyone would take a haircut based on how much they had on the exchange. And it worked really well, I thought. And when they had people take a haircut, they'd go, well, I guess our margin wasn't quite high enough. And they increased the margin a little more. It was about 35, 40%. And then, of course, the margin calls were made in advance when you still had 10% to cover. And if you didn't make the margin calls, your position would be liquidated. There was some cornering the market sort of stuff that went on. I probably benefited from some of it inadvertently. In hindsight, I looked at it and I'm like, wow, there was a market corner, and basically the other side capitulated. And so that's one problem, is if you don't have enough people with liquidity on either side and deep pockets, then that can happen, and maybe it can happen on a grand scale too. So weapons of mass destruction, maybe.
Another question over, we got a lot of questions, this is good, yeah.
Sorry. Is there a conflict in taking a product that's defined as decentralized and putting it on an exchange?
Not for
No,
me.
no,
No.
I mean, there's no legal impediments.
We're mostly happy to hear that, but there seems like there might be.
I think some people may have an ideological problem with it, with a decentralized product being put on a centralized exchange. There's plenty of people in the Bitcoin world that don't want to see that happen at all. They want every exchange to be decentralized. They don't want any government involved, any big corporations. But for me, for this entire space to become a new asset class, it has to have hooks into the traditional financial system. There's a lot of benefits to this technology that can run in parallel with big exchanges and big banks.
Yeah, and a centralized exchange does not transform something that's decentralized into
Right.
centralization. So it's just rippling through, an agency model. So really ought not to be any impact.
It's just like an equity system where you've got multiple places you can trade stocks, multiple venues. So
Yeah.
maybe if you had a broker, then they'd have to worry about best execution, and that would be a nightmare in the Bitcoin world, because you would be going to Hong Kong exchanges and French exchanges and everywhere, and anyway, it would be a nightmare.
So time for one more question, and then I want to ask our panelists for just one short and simple cryptocurrency prediction over, say, the next year. Okay, so there's yeah.
So I'll start by a remark, and I give the preface that I have a lot of good friends at JP Morgan who are very good people, but I do think it's a little ironic for Jamie Dimon to be making statements about fraud when JP Morgan got fined $2.6 billion for their business with Madoff, involvement with Madoff. So that's just a side comment. But with regards to the question, in terms of trading, two parts to this question. One is the mathematics behind Ethereum is such that it lends itself much better towards derivatives. And then in terms of trading, have you looked at some of the stochastic correlation structures between different cryptocurrencies?
I haven't gotten that deep. into the math and statistics. Frankly, it's been so easy because it's such an immature and illiquid market to make money on volatility that those things weren't necessary. Now, that said, I think maybe it's changing, and I think it could be very useful to do now.
So put call parity like in traditional derivatives, something very foundational, and there's arbitrage to be had if it's not satisfied. Has your firm yet started the research on things like that? That's like pretty.
We haven't, although when the CBOE options come out, I suspect that those will be mispriced, primarily because I think people are going to use it either just as a way to get exposure to it and will be somewhat price agnostic, won't care about vol, and or it'll be simply as somebody to hedge. So I don't think there's going to be a lot of options traders in there. So my plan is for my firm is to hire a couple good options traders to take advantage of that mispricing. So if there's anybody in the room, call me.
Send your resumes. Okay,
Yeah, exactly.
Let's start with you. Give us a cryptocurrency prediction.
I'm going to rewind to what I was telling people 5 years ago, which is it is digital gold, but it's got some differences, some important and notable differences. Gold has an intrinsic base value, which means that if it does go to zero means maybe $200 an ounce because it actually has a use. People like it for jewelry, lots of things like that. So it can fall out of favor for a number of decades and then be picked up again as a currency, and people remember their parents and their grandparents, oh, that was money. And so they've got this moneyness mentality. And if you look way back and you see people using shells as money and you see people using things of no value, but basically the thing was they were scarce in some way. That right there qualifies Bitcoin for money. Bitcoin could go to zero and something else could take its place because it doesn't have that intrinsic value. But it does have that psychological pull. It was the first. It was there, it was the first one, and it's got a lot of adoption, and don't ever underestimate liquidity. Look at the Eurex US. Look at all the other attempts, broker tech, that tried to take the liquidity from the Chicago Board of Trade. They could never do it, even though they charged 1/3 the commissions. Don't underestimate liquidity and existing adoption and the psychology that Bitcoin is something. If I had to make a prediction, I guess I would say it's going up. It's crashing right now. It's actually down to $3,300 already, so that's huge. But you can find equities that have done the same thing. So I say not scary, really, compared to the futures world. But I think it's going up. I'm putting money where my mouth is myself. If I'm advising the odd person, you have to be really careful. It's cash. People can rob you. And people can rob you while you're asleep, and they can rob your computer. It's got some other advantages over something more static like gold, though, which is you can copy your wallets. And you can put one wallet in Dallas and one wallet in New York, and if global warming floods out lower Manhattan or whatever, and you can't get your money ever again, guess what? You just get the copy. And you can't double spend the copy either because it's solved that problem.
Thanks. Brian?
So I'll give one that might be controversial, but why not? Let's go out there and do it. My prediction for the next year, as if you may all know, and we've talked about it, China has shut down all their exchanges. My prediction is that China creates an RMB-backed digital currency and reopens their exchanges, and you can only trade cryptocurrency against that RMB-backed digital currency. See what happens.
Awesome.
Maybe I'm wishful thinking.
It's a bold one. Yeah. Okay, great. Thanks, Brian. Sam?
Fascinating. My prediction is that given the importance of the blockchain transaction rails, most of the trading that you're going to see of digital tokens will be to further transaction records rather than a speculation in currency itself, but will actually be just a record of transactions such as smart contracts and other activities that move on the blockchain rails, and that cryptocurrency is going to be smaller than kind of the use of blockchain outside of a currency future.
I'm going to throw out 2 words for me, and that is more regulation. So on that note, I want to thank my panelists. Thank you all. Wonderful job. And
Thank
thanks
you.
all to you. I hope you found that.
Well done, sir.